Welcome to the Purpose Focused Advisor, a podcast for financial planners, advisors, and RIAs looking to get the most out of yourself and your business. Join Rob Brown as he walks you through a journey that will allow you to take action in your business and your life so you can be the best that you can possibly be. Now here's your host, Rob.
It's time once again for the Purpose Focused Advisor. Rob Brown here with my special guest today, Vance Barse. Vance is the founder of YDF, is what the firm goes by. But if you're trying to decipher that, it's Your Dedicated Fiduciary. I love that. I love that firm name. And as Vance and I were getting reacquainted before we hit the record button, we are puzzled as to how we first met, although we're sure we did. And maybe during this broadcast, we will get a chance to figure that out. And we also know that we're going to laugh more than once while we're talking. But prior to founding YDF, Vance spent a decade consulting with leading private wealth teams, which has led him to create YDF. And we'll let Vance talk a little bit about why he did that and who he serves. So maybe that's the best place to start off, Vance. Welcome to the show. Tell us a little bit about what got you here.
Well, Rob, thank you very much for having me on the show. I'm very excited for us to not only get reacquainted, but for the outcome of the discussion today. 19 life decisions led me to being on camera with you today. I have a measly undergrad degree in neuroscience from the University of Maryland, having grown up in Maryland. And when you graduate with that degree and are not going to go to med school, you have three options in terms of locations: Boston, where it's cold; San Francisco, where it's gray; or sunny San Diego. So I chose option 3. And my first career out of school was such that my then boss introduced me to a gentleman named John Sunt, the founder of Altegris Investments, which really was a platform of feeder funds into big names like Winton, Citadel, KKR, Paulson, and many others. And that was really the foray into the institutional investing world. And in that role, I spent 10 years meeting with different private wealth teams around the country to advise them on a number of things, but largely how to incorporate institutional alternative investments for their high net worth and ultra high net worth clients. And after a decade in that role and learning what I believe is everything that so many of the different firms don't do, I decided to create YDF largely with an emphasis on filling in those pretty big planning gaps that I often saw left behind.
So let's dig in there. So what do you think those gaps are? Because, you know, one of the things that I really enjoy about working with advisors, as most are looking for the gaps that they may have in their businesses that they need to fill now or that they want to move into in the future. So talk a little bit about those gaps that you saw and that you're trying to fill in with YDF.
So having consulted many of the so-called best wealth managers across the nation, best typically meant highest in assets under management. And under the conventional wealth management model, you have sort of the client at the center with their estate planner, the CPA, the wealth advisor, their P&C agent, the life insurance agent, and so on and so forth. It really is what I call a siloed business model, where there's not a lot of cross-collaboration among the different members of the so-called planning team. And very commonly, when I would go in to advise these wealth management firms and their financial advisors on how to essentially manage money for their high net worth and ultra high net worth clients, what I observed is that typically their service focused around portfolio management. Many of those advisors would actually outsource the management to a third party, which in and of itself, Rob, is not necessarily bad at all, but there's so many different planning gaps. For example, the tax world and the investment world very seldom coalesce into one. and having spent thousands of hours with financial advisors at essentially every major firm that you can think of, very infrequently does the advisor actually ask for and review the tax returns for the client. The tax returns are a wealth of information, no pun intended, of course, but things like capital gains distributions that might be coming from the legacy, very expensive, tax inefficient mutual funds that so many financial advisors for decades simply just by default put their clients' assets into. Not really a problem in retirement accounts like IRAs and Roth IRAs, but when you put that into a taxable account, whether it's a TOD or a joint tenants or even a trust account, the tax inefficiency of what's sort of under the hood in that portfolio, if you will, becomes really important. Because when a family onboards at the firm, one of the first things we ask for are tax returns. And we commonly get, why are you asking for my tax returns? Well, the answer is because if you think of us as a medical specialist, and I actually have a picture of Ben Carson and I up on the shelf over there, and I learned so much in my 45-minute discussion with him going back to my senior year of college, which is ultimately why I did not go to med school. But in any event, if you think of us as a financial specialist, we need the financial equivalent of the general health history. So if you've ever had a specific medical procedure done by a specialist, in almost all cases, they ask for the general health history from the GP. In an analogous way, we need to see the tax returns to understand historical capital gains, any loss carry forward. Is there farmland with a Schedule F involved? Do we have any sources of income that might be restructured to allow for more tax efficiency? The list goes on and on. So as I zoomed out and looked at the wealth management space categorically, I realized that not in all cases, but much of the time, there's a big gap between the tax world and the investment world. So we find it really helpful to obtain and review the tax returns, have a CPA consent form signed by the client, and initiate a very close working dialogue so that we can partner, metaphorically, with the CPA such that the net impact is the best result. And so much of the time we find that CPAs, and I know lots of them, hello to those of you who are watching this, so much of the time the CPA or tax advisor is a reactive tax filer. Very seldom are they saying, hey, Mr. and Mrs. Jones, it is October 1st, and we'd like to get all of the current year information now so that we can use the last quarter in the year really to look at the different tax alleviation and tax reduction strategies for which you might be eligible so that we can work with the advisor and the other allied professionals, often the estate planner, to reduce your tax bill as much as possible strategically, proactively, and in the current year. Another common gap that we would see is the one that can exist between the estate planning world and the investment world. Does the family have a particular trust? Is there a fact pattern with the family profile where one or more irrevocable trusts can be implemented? Is there a family business? Does the family own multiple pieces of real estate? And when you have particular expertise in the advanced planning area, you're able to establish a working dialogue with the estate planner and proactively introduce these more sophisticated, generally, strategies to not only the estate planner and the CPA, but ultimately the client to become that client's in-house most trusted right-hand advisor to make sure that all of the different planning gaps that can potentially exist are in fact filled.
So as I hear you describe those two gaps, and those are areas that where there could be really big gaps. I see that all of the time in talking with advisors, and I'm sometimes surprised that they are missed or not noticed when they seem so obvious. I was a practicing financial advisor for over 25 years, and I maybe I got lucky, but I just thought the tax return was a really important thing to have, and it made planning for me and for the client better. But as you think about that, why do you think that kind of those silos exist? Still, when again, maybe it seems obvious to you, maybe it doesn't seem as obvious to some of the folks who are listening to this podcast.
Because the entire industry lacks the requirement for cross collaboration. So, for example, if I'm a P&C agent or property and casualty agent, client comes to me, I might do home, auto, possibly an umbrella, and I'm signed, sealed, delivered, I'm done. We'll send them a renewal notice every year. If it's an independent agent, they might shop different carriers. But when you have an evolved fiduciary financial planner who can understand the intersection of, for example, risk management and estate planning, several of our clients own investment real estate. Many of those will put those pieces of property up on Airbnb. Well, or VRBO for that matter. But the host company, let's say it's Airbnb, will offer a particular policy to help insure against a type of event that happens during the coverage. But what happens if you have, and spring is coming up, right? You have some spring breakers that are coming out from, I don't know, Arizona. We're going to San Diego to party, right? And they show up at the house early. They're overserved alcohol at the airport. They have a slip and fall, or they hop the fence to go into the pool because who can wait for the pool when tequila is involved? And all of a sudden, there's a $750,000 medical bill. Well, if the estate is worth $5 million and we account for the statutory exclusions around the homestead and the IRA provisions, there might actually be a level of insurability gap that the estate owner has, whereunder the Airbnb policy does not cover it because the person hurt her or himself outside of the window of check-in and check-out. Another example is if you're in an at-fault accident, whether it's really their fault or not, this is where litigious attorneys come into play. Is there, for example, $750,000 of liability that exists above the current policy for an automobile limit where the homeowner is at risk and they don't have an umbrella? The number of times we have reached out to property and casualty agents to introduce the idea of implementing an umbrella policy for a particular client is well north of 50. And the P&C agent goes, that's a great idea. I never really thought about the fact that they could benefit by having a $1 million or $5 million, or in some cases $10 million liability umbrella policy, because it's just not front of mind. So when we have the different practitioners, to sort of zoom out and answer the high level question, when we have these different practitioners who are in their lane, focused idiosyncratically on their expertise, and they're not thinking outside of that particular box, the problem with that is that there can be inadvertent planning gaps. And part of our job, quite seriously, is to fill those to make sure that at the end of the day, Rob, the entirety of that estate is in a nice, pretty box with a metaphorical, pretty bow on top, and the client can simply live their lives with purpose and fulfillment.
So a couple of great thoughts came to me, or maybe not great thoughts, a couple of thoughts came to me out of what you just said, Vance, was one, you aren't necessarily trying to change all of those relationships that circle that client. You're just trying to make sure that those other advisors, the tax accountant, the estate planning person, the PNC advisor isn't just a name in your CRM that you could contact if something came up. You want to contact them proactively based on what you know is important for your client, to see if there are some things that they may not be aware of as it relates to the client's entire situation. So they're still there, they're still important, but it's like I said, it's not just a name in your CRM system. They're partners with you on that client, and if they aren't, I imagine you try to find a way to replace them.
Very much so. So we will tell the clients during the onboarding process that we are literally your biggest advocate. We are the quarterback. We are the cheerleader. We want to actually bring in these allied professionals so that you have a planning team at the family board table, if you will. And they don't have to be huge, complex estates. When you think about it, the most underserved cohort in wealth management, in my opinion, is the 2 million to 20 million liquid profile. And that's a big range. But the reason for that is so much of the wealth management industry focuses on the so-called retail millionaire next door. And there are certain planning requirements that they have. But in the private wealth and the trust world, many of those planning teams have a $25 million liquid AUM requirement. So if you don't have 25 million, you're not even going to have a conversation with that particular wealth management team for solutions. And so many of those profiles, Rob, are introduced to these financial advisors because of the banking relationship. Many of them are executives and or business owners, often both, and they need access to capital. So what do? They go to the bank, and then the bank individual that is helping them introduces them to a financial advisor, and all of a sudden you now have SMAs and the in-house products and the in-house portfolios as part of the wealth management experience. But having been in that silo for so many years and working under that model as a consultant to those advisors, it's really important to understand the inherent value of the cross collaboration, which really brings me full circle, because we will ask for contact information and authorization forms to be signed so that we can reach out to these folks on the client's behalf. We request absolutely every piece of information that includes a dollar sign. So if the client has outside concentrated stock, for example, we have some executives in the Bay Area that have pretty concentrated stock positions. There's a lot that we can do on and advise pursuant to those highly concentrated stock positions, particularly in the advanced planning arena. We will link the data feed from those outside positions into our system, which is Investor 360, because we want the clients, when they log in, to feel like they are in the cockpit of their own estate so that everything is right there at their fingertips. That includes copies of passports, driver's licenses, all the estate planning documents, all tax returns. I mean, you name it, it is in there so that we can fulfill our duty to our clients to make sure that we are advising on all of the above.
Yeah, and that brings me back to the other thing that you made me think about here is you're boldly, by naming your company, Your Dedicated Fiduciary, grabbing a hold of that fiduciary word, which is used so many different ways in the industry. So talk about that. Talk about why fiduciary, because that lays a lot of responsibility on you, especially when you say right up front, I am your dedicated fiduciary. It's not just, something you say in passing, oh yes, I'm a fiduciary. You're saying, I am your dedicated fiduciary. Why that term, and why do you step into it so hard?
So I feel very fortunate to live a life of passion and purpose, particularly with and for my two kids, who I hope will see this someday. They are ages 7 and 5. My 5-year-old, by the way, is going on 15. Like, no, you cannot have the keys to daddy's SUV. Stop it. In any event, she's my baby girl. But in any event, having been inside the wealth management industry as an internal consultant, I had the ability to meet with clients and their advisors so much of the time. And it was interesting to me because advisors would tell their clients, I'm a fiduciary. I'm only going to do what is in your best interest. Well, I happen to know that the advisor has 20 or 30% of their assets in commission-based products. I won't name the specifics, but is it really in the client's best interest to be introducing 20% of a portfolio in high commission real estate investments when the client already has X millions of dollars within the real estate sectors based on maybe they own apartments, maybe they own parking lots, and so on and so forth. And I just consistently saw that there was no requirement that the advisor truly do what is in the client's best interest. And that bothered me. It bothered me tremendously. And in the transition from my former career of consulting, and I jokingly say babysitting financial advisors around the country, to actually becoming one, I wanted to present to our clients and the public that we, without question, 100% of the time, are going to do what is in that client's best interest, not only as it relates to the products within the portfolio, but also as it relates to the strategies that we would introduce, right? Sometimes people will call in like, I'm looking for some tax loopholes. Well, sorry, you've come to the wrong place, because any of the strategies that we would introduce are within the IRC or the Internal Revenue Code. We're not CPAs. We're not going to file your taxes, but we are going to pull in your CPA to strategically introduce different types of strategies, some of which, by the way, really incorporate estate planning and tax strategies. So intentionally defective grantor trusts, irrevocable life insurance trusts, depending on the interest rate environment, grantor retained annuity trusts. For certain profiles, spousal lifetime access trusts can become very appealing. And
Right.
Every different profile is different, but having a deep working knowledge of those strategies for which a particular profile can become eligible allows us the opportunity to truly satisfy that role of in-house, right-hand, most trusted advisor.
Yeah, I like that because, and I asked the question not to put any advisor on the spot, but to really highlight that standard to which you need to hold yourself when you're doing something as important as the work that financial professionals do. And you're never going to be perfect. You're never going to always get the client to agree to do the thing that's even best for them. But if you're always looking out for what's best for them, then you're headed in the right direction 99.9% of the time. But you also talked about purpose and passion. Let's put aside the trusts and the tax returns and all that other stuff. What is that in that purpose and passion that you have for what you do? Because as we were kicking off this call, as an example, you talked about how this business is so important for you because of the responsibility and the joy that you have in raising two kids.
Rob, I wake up every day and I literally never feel like I'm actually going to work. And I have friends who will call me on their way into their office and like, oh, Taco Tuesday, going to the office, right? And I just don't feel that. And I feel so fortunate. I'm just truly fortunate. We have 3 different office locations, one in Prosper, Texas, which is just outside of Dallas, one in San Diego, and one in Lodi, California. Yes, like the CCR song. It's about 40 minutes outside of Sacramento. And then there's a large cluster of clients that we have in Maryland, where I'm originally from and grew up. And it's common for me, very common for me, to travel to them. And when I get together with them, we have what's called a PDM, or a partnership development meeting. It has each of the planning items, estate planning, tax planning, investment management, and on down the list, delineated on this so-called agenda. But so much of the time, the conversation is just catching up among friends and asking what is most important to them. And part of that conversation, clients go, hey, your birthday's coming up, Vance. You're going to be 45 years old. What do you have planned with your kids? And it's ultimately being in the business of personal. There's no separation of church and state. And I feel so truly lucky to have the opportunity to have, call it 100 families that are friends for whom my team and I solve these problems, whether they are intricate and complex or super basic like Roth conversions and tax bracket management. To do that in a way where you get to observe the impact and the materialization of the strategies within their families and watch them live life literally to the fullest, it's the greatest honor.
Yeah. Well said. Well said. I appreciate that perspective, because I'm guessing that when you tell those Maryland clients, hey, I'm headed your way, they aren't headed to Florida. They're like, no, I can't wait till you come, because we get so much out of that time that we have together, both because you're my financial professional, but also because we get each other. We know each other. We love each other. We appreciate each other, and we like that time to be able to just be together.
Yeah, it's interesting. Some life events last year led me to do a couple different deep dive personality tests, and it's really good for people to do those to understand what makes them tick, who they really are, and both of those outcomes were Sigma empath. I'm like, Sigma empath. So I Googled, what is a Sigma empath? And as I'm reading the description, I'm getting goosebumps, because it's like I'm reading a description of how I view the world, and every single interaction that I have with another human being, whether it's a bozo on a bus or a billionaire in a Bentley, it's another opportunity for a genuine, authentic connection. And I feel like so many humans go through life where other humans are just kind of strangers at the DMV. And there's that. I actually enjoy going to the DMV. I recently took my kids there. We're having a hoot. We're talking to the people on our right. We're talking to the people on our left. We made it a party, man. It was great. I walk in and I get the ticket. It's like Z48, and they're now calling B23. Awesome. We're going to be here for a while, kiddos. Right? But I just find so much joy and fulfillment in working with other humans, and I wouldn't trade it for the world.
That's awesome. So what's next for YDF? What are your plans as you move ahead? Do you have some growth goals or some specific areas that you want to move into to extend what you're doing?
So we're at about 100 households, give or take. And I'm at the point where the number one thing for me in my mid 40s is being the most phenomenal dad to my kids. Like, first and foremost, clients know that. I'm very open about that. And so I structure my time such that on certain days, I will work 12 to 14 or 16 hours, so that on other days when there's tennis or gymnastics or whatever, I'm able to be there with my kids, fully involved without any distraction. So I don't have any desire in empire building or becoming a $1 billion RIA. And I don't mean that with any knock to those folks, but
Sure.
There's nothing that motivates me to wake up in the morning and go, I'll be happy if, or I'll feel satisfied when. We're good. We're great. And we can be really selective as to with whom we work. And one of the steadfast requirements that I have, Rob, is that if we're going to take a client on, we have to bring or have the ability to bring tangible value that they're not currently getting. And so one of the things that I did from a business standpoint about 5 years ago is I implemented a flat cost consulting retainer. So a family might reach out to us, or in some of my travels, I'll just talking with strangers, as I've mentioned, on planes commonly. They might go, I want to hire you. I've had my advisor at two-name firm for the last 27 years. Maybe, he's good. He's really good, right? Or she's the best. I go, that's fine. But they still want to have us do a review. So we will do a flat cost retainer consulting agreement where we ask for the investment account statements, tax returns, estate planning documents, all insurance policies, and a household balance or ledger if they have one, and anything else that is materially relevant. And we do a deep dive and turn around and give the client a report on our independent objective findings on what we think is good and should remain, those areas that might be in need of improvement, and then any major planning gaps that they have, and specifically how to fill them. And that has been the methodology of growth. It's just happened. Like, I know a financial advisor out of San Diego who has absolutely mastered search engine optimization. And I took him out a couple years ago and I said, hey, I want what you have. What is that? I want the ability to clickety clack on the internet and have people do Google searches and find me. And he goes, well, I want what you have. I go, what is that? He goes, you've never met a stranger. Like, you literally talk to people on airplanes and will pick them up as clients. Like, I could never possibly do that. I'm like, well, here's the beauty about traveling on an airplane. People will tell you things that they never otherwise would, because either they think that they're never going to see you again, or you're going down in flames together, right? So they will open up about, certain items that they just won't under most circumstances. And it's an inherently intimate setting because you're basically cramped up and you're kind of forced to suffer through the airplane ride together. But to answer the question, at this point in time, we might do one more acquisition of a conventional financial planning firm. There are a couple states that I love visiting, one of which is in the South. And if an opportunity presented itself, we would certainly tuck that advisory location in under our broader umbrella. But otherwise, it's just organic growth as the opportunities present themselves by way of meeting people.
I really love some of the things that you said. Because, and again, not to disparage somebody who has that goal of being the $1 billion or $2 billion practice. If that's what drives you, that's okay, because a lot of those people that are driven to those $1 billion and $2 billion practices do a lot of good with what they're able to create in terms of income because of what they built. So it's not a, live a great life and make a lot of money and don't pay attention to anybody else. So I get that, but I also know that for a lot of advisors or for a lot of wealthy people, the next level of income or revenue or AUM will be the level which they can say, oh, now we can slow down. Now we can pay attention to our kids. And you're saying, hey, I'm going to flip that. I'm going to say kids first. I want to make sure that I am loving them and spending time with them the way that I should. And I'm still able to create this growing business that I really enjoy and enjoy the people that are there. And it's all going to work together, but the business isn't going to make my life with my kids better. My life with my kids is going to be better because I'm with my kids. I'm making them my first priority. Did I say that right? Does that make sense?
Yes, I will tell you, in 2025, I adopted this YOLO bro kind of mentality. So my 7-year-old was watching a video on YouTube and he looks up at me, he says, Daddy, YOLO bro. I'm like, YOLO bro? He goes, yeah, you only live once, bro. And I'm like, that's my boy, right? We are going to live it in 2025, my man. And it's easy to say, but in practice, it really takes some focus because it is important to make money. But you have 18 to 20 summers in which to enjoy time with your kids, and they're gone, right? You can always make more money. And it's not to dismiss the importance of saving for retirement or making smart financial decisions, but you never know when it's your time. And I really do think that life is meant to be lived happily, calmly, and in a way that if we're lucky enough to be sitting on our metaphorical or literal deathbed, staring at a ceiling, looking back and going, what kind of human was I? What kind of parent was I? No one, when 3 generations, is going to remember what you did. And often when I lecture at conferences or to small groups, I'll say, by show of hands, who here remembers what their great-grandfather did for a living? Nothing. No one. So what's the point in slaving away to basically amass a huge fortune for what? You got to live, and it's it's just great to have the ability to do that.
Yeah, because truthfully, every day you're writing your autobiography, and it's going to be either one that people want to read, your kids and your grandkids and your great-grandkids want to read, or it's going to be one that's kind of devoid of any real purpose and meaning. And it doesn't mean that they don't love Grandpa, but it's a little different. And I just think that way of thinking about writing something that is special with your life, where your purpose and your passions, really come out and work together. Vance, it's time to land the plane. This has been a great conversation. Any last minute words of wisdom for the audience?
Hashtag YOLO, bro. That's it, Rob.
I'm just glad you told me what YOLO means, because I am terrible with acronyms. And I was like, I don't want to be embarrassed and have to ask him what YOLO means, but I love it. I love it. So Vance, thanks for being on the show. To our guests, thanks for listening in. We will see you next week. And as always, we are rooting for your success.
Thank you, Rob.
Thanks for joining us for this episode of The Purpose Focused Advisor. If you want to learn more, head over to our website, truestfancoaching.com. There you'll learn all about becoming a purpose-focused advisor. You'll also find today's show notes and links to the other gifts and resources we talked about during the episode. Again, thanks for listening, and remember, we're rooting for your success.